This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 4 videos on reversals. I'll begin by defining what I mean by a reversal. And next I will distinguish between a minor reversal, which leads to a trading range, and a major reversal, which leads to an opposite trend. And I'll make the point that reversals begin with breakouts. Even if the breakout is small, there's almost always a breakout at the start of a reversal. We have a bull trend and then a bear trend. The bull trend reversed into a bear trend. And we have a bear trend that reversed into a bull trend. A reversal at the top, a reversal at the bottom. A bull trend and a bear trend are opposites, and when one changes to the other, the trend is reversing from up to down, and then from down to up. Remember, all markets are either always in a trend or a trading range, and a change from one type of market behavior to another is a reversal. For example, a bull trend that becomes a trading range is also a type of reversal, although most people do not usually use the term reversal. We have a trading range and then a bull breakout. It's a breakout, and that's the term that I typically use, although you can argue that it's also a reversal because it's going from one type of market behavior to another type of market behavior. A bull trend became a trading range. Traders often call that a consolidation or a pullback. It begins as a pullback, but once it grows to 20 or more bars, the odds of a bull breakout fall to the same as the odds of a bear breakout. And instead of calling it a pullback, I use the term trading range. Trading range means the probability of a bull breakout is the same as the probability of a bear breakout. Early on, when you begin to pull back, the probability favors that the trend will resume. But as more bars get added, the probability becomes more and more equal for the bulls and for the bears. Every change in the direction of the market, every change in the behavior of the market is a reversal. We have a small trading range up here, and most reversals involve some kind of a trading range. Normally, a bull trend does not go from a bull trend to a bear trend without first at least going into a trading range briefly. A bear trend usually does not go into a bull trend without at least becoming some kind of a small trading range. Here we have a small double top and a bigger double top and a bear reversal bar, and we got the reversal. Here we have a small double bottom and a decent bull bar and a reversal up. This is the euro versus the dollar, a 5-minute chart. The market's constantly trying to reverse. Every few bars, there's a reversal attempt. We have a bear breakout and bad follow-through. The bulls are trying to reverse the bear breakout. The bulls did not get much of a reversal here, but this is the reversal occurring 19 bars after the bear breakout. It's a 2-bar reversal, down on this bar, up on that bar, separated by 19 bars. But this is the reversal. You can call it a bull reversal, you can call it a reversal, it doesn't matter what you call it. The market was trying to go down, and now it's clearly going up. It's a reversal. The market's rallying strongly here, and then another leg up. But then look at this. This bar totally reversed that bar. It's a small reversal. On a higher time frame chart, like a 10-minute chart, this would be simply a doji bar. It would look something like this. It's a reversal. However, it did not lead to an opposite trend. It simply led to a trading range. This bar is a small bull bar, and it's followed by a bear bar about equally big. This is a small reversal within a very tight trading range. Meaningless, probably simply going to go sideways more instead of breaking to the upside or the downside. Every tail on every bar is a reversal. The market tried to go up, and then it went down. The market went down, and then it went up. All of these tails are reversals. The market went up and then down, up and then down, up and then down. Here's a 2-bar reversal, and it's simply a doji bar or a tail on a higher time frame chart. The market went up and then it went down. This is a reversal, and on a higher time frame chart, like a 60-minute chart, this would simply be a doji bar, a bear reversal bar, up and then down. This would simply be a bar that opens over here, closes over here, and has a big tail on top up here. This is a tick chart based upon one tick. This is one tick down, and then we went sideways for a tick, and then we went up for a tick, sideways for a tick, down for a tick. We traded here, and the very next trade took place down here. The trade after that took place up here. This is a reversal. Even though it's only on a tick chart and it would be invisible on a higher time frame chart, it is a reversal. The market traded down. The next trade, it traded up. The trade after that, it traded down again. It went up and went down. It's a reversal, even though it's only 2 trades, up and then down, and it took place probably in a fraction of a second. It's still a reversal. Any change of direction is a reversal. This is the euro versus the dollar. This is a 1-tick chart. The market went up a tick and went up another tick, and then down and up and then down. This is a reversal. The market went up and then it went down. The market was trading at this price, and the very next trade took place here, and then the very next trade took place here. We reversed up here, we reversed down here. Even though it's only 1/10 of a pip, if you look at the prices, it's only 1/10 of a pip. The market went up 1/10 of a pip, and then it went down 1/10 of a pip. It reversed from up to down, and then repeatedly reversed through here. But every one of these changes in direction is a reversal. I want to distinguish between minor and major trend reversals. I think is very important. A minor trend reversal, for example, a bull reversal in a bear trend usually becomes a bear flag. We have a bear trend and we are reversing. Can this be the start of a bull trend? Not likely. When the bear channel is tight like this, usually the first reversal up becomes either a bear flag, which this was, or it becomes part of a trading range. A major reversal requires more bars. A major reversal means the market goes from a bear trend into a bull trend. That's a big change. It usually requires more bars, 10 bars or so. This reversal in a very tight bear channel is likely to fail, so traders are ready to sell a failed reversal. They look to sell on a stop below the low of a bar, preferably a bear bar, betting that the bear trend will resume. A small double top bear flag with a bear bar. The reversal up, not very strong, probably a bear flag. A good reversal up from a higher low major trend reversal, bear trend, break above the trend line, and then we have a double bottom higher low with a good bull buy signal bar, and a good breakout bar closing above the high of the past 15, 20 bars, and a follow-through bar. The bulls have won. The bears are trying to reverse back down, but probably only a minor reversal, which means either a trading range or a bull flag, probably going to go at least a little bit higher. You look to buy a reversal up, especially above a bull bar, either here, get long here, or above this bull bar and get long here. This, again, is a major trend reversal. We have a bear trend, a break above the trend line, and the entire pattern has about 10 or 15 bars in it, up 6 or 7 bars, down 6 or 7 bars. Big enough pattern to expect 6 or 7 or 10 bars up, a major reversal. This is a higher low major trend reversal. This low is taking place above the low of the bear trend, and therefore it's a higher low reversal. It has enough bars for it to be major, so traders can expect 5, 10, 20 bars up. It's also a double bottom, so it's a double bottom, higher low major trend reversal. Again, minor reversals usually lead to trading ranges or flags and not opposite trends, but sometimes the trading range can contain a major reversal. Here, a minor reversal, a very tight channel. Probably the best the bulls get is either a bear flag or a trading range. And in this case, they got a trading range. Some traders will hold for part of the position. Since a bear flag or a trading range is likely, traders scalp most or all of the position. Some might hold part of the position in case the trading range forms a major trend reversal and you get a trend up, bull trend. Here we get a bull trend lasting about 30 bars and a slight lower high, but the entire pattern here is only 4 or 5 bars. It's probably going to be a minor reversal, which means either a bull flag or a trading range. Traders will sell for a scalp for sure, and some might hold for a swing, hoping that we get a trend back down to here or to here. I want to say something about noise. It's a term you often hear when people are talking about trading. Noise is simply a minor reversal. For example, we have a bear trend, we're trying to reverse. A trader who's swing trading will ignore minor reversals, and sometimes someone will say, oh, that's just noise. Also, in a tight trading range when the market is making multiple reversals, some traders will ignore them and refer to them as noise. My definition of noise is simply something that is so small that you will ignore it. And I never use the term noise, I use the term minor reversal. Because noise implies something is random, something is happening that is purely random, and nothing can be random. Everything that takes place because computers are making it happen. Everything is done because of logic. Just because something is happening and it's so small that you're choosing to ignore it does not mean it is random. It's real and it's taking place for very good reasons. The computers are placing trades because they see logical trades, even though the trades are so small that you would never consider taking them. Some minor reversals are big enough for scalpers to take, not simply the computers trading for 1 or 2 ticks or 1 or 2 pips. However, they still are minor, and because a scalper is taking them and making money from them, they cannot be random. You cannot make money from random moves. You can only make money from logic, and therefore noise cannot exist. Whenever you hear a person talk about noise, I think they're being ignorant. They're implying that they're either not understanding why the market is doing what it's doing, or they're simply choosing to ignore what it's doing. Ignoring what it's doing is acceptable. If the time frame of the movement is so small that you're choosing not to trade it, that is fine. But to call it noise and believe that it's random is foolish. That's ignorant, because everything that happens for a reason. My definition of noise, minor reversal, and I prefer to use the term minor reversal. I want to talk a little bit here about a swing trade from a bear trend to a bull trend. When the market's in a bear trend, traders assume that every reversal attempt will be minor, which means it'll become a bear flag or a trading range. And they continue to do that until they see a minor reversal that is especially strong. For example, if it breaks above the bear trend line and rallies for 10 bars or so, or even goes sideways for 10 bars or so, that is a sign that the bulls are becoming stronger and the bears are becoming weaker. This is still a minor reversal, but it's warning traders that the trend might be near an end and it could convert either into a trading range or a bull trend. Once the bear trend resumes from this minor reversal, traders suspect that the next reversal attempt might be more than a minor reversal, and in fact, it might become a major trend reversal. In general, when you have a major trend reversal setup, you have about a 40% chance that the reversal will in fact lead to an opposite trend. 60% chance either the market stays sideways or the bear trend resumes. Here we have a high or low major trend reversal. A minor reversal that's fairly strong. It broke above the bear channel, and now the bear trend is resuming. Traders will be ready for another reversal attempt, and there's an increased probability that this reversal attempt would in fact be major. We have a couple legs down. We have a double bottom with this low, slightly higher low double bottom, and a decent buy signal bar. Swing traders will buy above the high of this bar and get filled here, betting that there's a 40% chance we'll get a major reversal and at least a couple legs up for a swing trade. Let me talk about the opposite. Let me talk about a bull trend reversing possibly into a bear trend. When the market's in a bull trend, traders assume that every reversal attempt will be minor, which means either you get a trading range or a bull flag and the bull trend will resume. However, if you get a strong enough minor reversal to break below the bull channel, below the bull trend line, especially if it lasts 10 or more bars, traders will wonder if the bull trend might be ending and either converting into a trading range or into a bear trend. And therefore, traders will look to sell the next reversal down, betting that maybe it'll become a major reversal into an opposite trend, a reversal from a bull trend into a bear trend. In general, 40% chance. Here, the bears are trying to get a lower high major trend reversal, a second entry short. The first attempt is below here. Most traders would not short that. And now we have a second attempt at a lower high. Traders would either sell there or below this bear bar. My concern about this as a major trend reversal is that the sell-off lasted only 5 bars, and that's usually not enough to lead to a major reversal. It might. The rally was weak, and the pullback from the high lasted 10 or 15 bars. Maybe there was a 40% chance this would result in a major trend reversal. Instead, it just resulted in a second leg down, and then a larger minor reversal, that had 2 legs down, one pullback 2 into a large bull flag, and then the bull trend resumed. However, at this point, the pullback from the high lasted about 30 bars, and that is a lot of bars, and that is a lot of time when the bulls were no longer in control. The market was balanced. Traders are aware of that this is a very big minor reversal. Therefore, if the bull trend resumes and tries to reverse again, there's a better chance for a major trend reversal down. They'll look to sell. This breakout is strong enough so that the odds are there'll be at least a small second leg up. After that second leg up, traders will look to sell a slightly higher high major trend reversal. This is a reasonable swing short, or you could sell below this bar, low 2 short, low 1 below here, low 2 here, and then a pullback from this bear breakout, consecutive bear bars. The odds are we're going at least a little bit lower. Again, 40% probability of a swing down, which means at least a couple legs. Usually when a swing trader is looking for a swing short after a major trend reversal, he's expecting at least a couple of legs down, and he's also expecting the reversal down to last 20 or more bars and lead to a reward that is more than twice the actual risk. Here it's many times greater than the actual risk. A swing trade, a bear trend to a bull trend to a bear trend, or a breakout of a trading range. Here we have a trading range and a bull breakout. This is a potential swing trade for a couple of legs up at a minimum objective. We have a breakout bar closing above the high of the past 20 or 30 bars. High probability of going at least a little higher. And then the follow-through bar, the bar after the breakout bar, also closed with a bull body, and it closed on its high, and it closed above the high of the breakout bar, and the open of the follow-through bar is above the close of the breakout bar. That tells you that as soon as this bar closed, a lot of traders hit the button, buy the market. So we had many traders trying to buy the market as soon as this bar closed. The open of this bar then is above the close of this bar, and that's a sign of very eager buyers, and it increases the chances of some kind of a measured move up and 2 legs up. First leg, pullback, second leg. We got a third leg up as well. Almost all reversals begin with breakouts, although the breakouts are not always obvious. Sometimes they're small. A reversal is a type of a breakout. We tried to resume the bear trend down. We have a bear trend and a couple legs up, one pullback, two, and now the bears are trying to get a downside breakout. Instead, it reversed up here and then especially here. This totally reversed the bear breakout. And every reversal is a type of a breakout. Remember, every bear trend bar is a breakout and it's a sell climax. Every bull trend bar is also a breakout and it's a buy climax. We have a big bull trend bar, it's a breakout, and it could be the start of a bull trend, or a bull swing at least. All reversals begin with at least a small breakout. This is a bull breakout. You can say it's a bull breakout above a trend line, it's a bull breakout above a trading range, it's a bull breakout above the bear breakout. The bears gave up. The bears who sold here, hoping for trend resumption down, bought back their shorts. The bulls became confident that this is a higher low major trend reversal and we would get at least a second leg up. Once they saw the breakout bar and the follow-through bar, they assumed that this was the first leg up and that traders would buy the first reversal down and expect one more leg up. This is a give-up bar. The bears are giving up. The bears who sold are disappointed by this bull bar. They hoped that we would resume down, and when it started to go up, the bears bought back their shorts for a loss, and they gave up on this bar. Every trend is in a channel, so every reversal breaks out of a channel. We have a reversal up. There has to be a channel somewhere. There are many ways to draw it. One is using this reversal down and this reversal down. You can create a parallel and connect it and make it a best fit. This is then an outlier. However, it's a bear channel, and this is a bull breakout. We have a bull reversal, so you know it has to be breaking out of a channel. Whenever there's a breakout, whenever there's a big trend bar, especially when there's follow-through, traders agree that the price is wrong, and it has to move quickly to find a new fair price. It doesn't matter if you're talking about a breakout or a reversal, you trade them the same. Is this a bull breakout above a trading range? Is it a bull breakout above a bear channel? Is it a reversal up from this bear trend? It doesn't matter what you call it. The market's going higher. It's all of those. It's a breakout and a reversal. A big bear trend bar closing on its low. The bulls tried to bottom here, and instead we got a bear breakout. This means that the price is too high and the market has to go lower to find buyers. It's a breakout, we're going lower. This is a reversal, it's also a breakout, we're going higher. Price is too low, price is too high. A bear trend is a bear channel, and there are lower highs and lower lows. For the bear trend to become a bull trend, it has to break above the bear channel, and then it has to start to create a series of higher lows. We have a low, we have a slightly higher low, a slightly higher low, and a bull breakout. This looks like it could be the start of a bull trend, and in fact it was. We have a bear channel, and once there's a breakout above the bear channel, traders will look to see if the market tries to resume down and fails and reverses up. And if so, in this case, we get a higher low, major trend reversal. The bulls are looking for a reversal up after an attempt to resume the trend down fails. The bears trying to resume the trend down. Instead, we got a big bull trend bar. The bears are trapped into a losing trade, and the bulls are happy, thinking that they've caught the beginning of a rally that will have at least two legs up, one pullback, two. Bear breakout, but bad follow-through for the bears. Bulls will buy above the high of this bar, taking a chance that it's a higher low major trend reversal, and they want it to be the first of many higher lows and the start of a bull trend. In both cases, the market's going down, It clearly believes that the price is too high, and it has to move down fast to find a new fair price. Does it matter if one is a reversal and one's a breakout from a trading range? It doesn't matter, you trade them the same. The market's telling you that the price is too high. We have a trading range and a bear breakout. You're going to sell it. Because the market's going down fast, it's probably going lower. In this case, we have a bull trend that reversed down. You trade it exactly the same as you trade this. The price is clearly wrong. We have a bear breakout, and here we have a bear breakout. This is a reversal, up and then down. It doesn't matter. You trade this the same as you trade that. You sell closes, you sell for any reason. The market is telling you that the price is too high and it's going to go lower. It's going down to find a new fair price. Bear breakout below a trading range, bear reversal, doesn't matter. You trade them the same. The bear trend here looks the same as the bear trend here. It does not matter what came before. You trade them the same. The market is looking for a new lower price. Sometimes a reversal can be obvious after simply a single bar. We have a bear trend, 3 pushes down, 1, 2, 3. Consecutive sell climaxes here, a little bit here, more here, more here. Probably going down too far too fast, and the odds are it's going to reverse. Here we have a single very big bull trend bar closing on its high, totally reversing this final bear trend bar. We're probably going higher for at least a couple of legs. A single bar like this can be enough to convince traders that a reversal is taking place. Strong bull reversal, wedge bottom. Traders expect that the market's always in long and that will go higher. And with every additional bull bar, the traders become more confident that will go up for some kind of a measured move. Some reversals take place with one bar, some take a lot of bars before it becomes clear that the market has reversed. This is the high of this bear trend. However, initially this is simply a pullback in a bull trend. And the pullback kept growing and growing and growing, 20 bars or more. And at some point you have an endless pullback, a pullback that just keeps growing and growing and growing. The more bars that get added, the more the market becomes 50-50. The probability that the market will resume up drops to the same as the probability that the market will reverse down. Usually after about 20 bars, the probability is the same. This is a transition from a bull trend into a bear trend. This is the early stages of a bear trend. It's still a bull flag, and it's also a trading range. However, it's the beginning of a bear trend. It did not clearly become bearish until we had a couple big bear bars here, and then here, maybe here, 2 or 3 bear bars. At that point, the market has clearly reversed, and we're going lower for at least a couple legs. 1 pullback, 2, or 2. We have a parabolic wedge top, 1 or 1, and then 2, 3, and then a pullback for 5, 10 bars. It became 20 bars, endless pullback. And you have to be thinking that instead of a pullback, this is a trading range, and the market has an equal chance of a downside breakout as it does a resumption of the bull trend. This totally reversed the rally. Bear channel, bull flag. But the more bars that get added to it, it becomes an endless pullback. And once you have about 20 bars in a pullback, you have to be thinking about the probability of a bear breakout is about the same as the probability of a resumption of the bull trend. The bears need 2 things, a breakout bar and a follow-through bar, preferably a big bear trend bar closing below its midpoint or closing on its low, followed by another bear bar. And if they get that, you probably have a measured move down at a minimum. It becomes a measuring gap. Strong bear bar, big trend bar closing below its midpoint, good follow-through bar closing around its midpoint, but with a bear body. The bulls gave up. The bears saw the bulls giving up, and the bears sold strongly, expecting at least 2 legs down. Here we have a bear trend and a reversal, but it's a bear flag, yet we got a bull breakout above the bear flag. Again, an endless pullback, and then a bull breakout and a follow-through bar. Bull's channel, so a bear flag. And we tried to get a bear breakout. We tried to get a bear breakout again, but failed. And it looks like we may be breaking above the top of a bear flag. We might be getting a bull breakout above a bear flag, and that can lead to a measured move up. This low tested this high, possible measuring gap here, and we went up for about a measured move. The breakout was very clear here and here. We have a bull trend bar here occurring in a bear flag. More and more traders are beginning to believe that the bears are going to lose and that we're going to get a bull breakout above the bear flag and a measured move up. Now we have 3 consecutive bull bars closing on or near their highs. And then we have a pullback trying to reverse, but this low stayed above the breakout point, so we might have a measuring gap here or a measured move up. Very big bull trend bar, probably going higher. Follow through bar, probably going higher. And it's a bull breakout above a bear flag. We broke out here, we broke out here, we broke out here. This is when it became most clear. And what this is the bears giving up. They're finally giving up. I call it a give up bar, a pair of give up bars, the bears giving up. I began by talking about what I mean by a reversal. A reversal can be simply a change in behavior from a trading range to a bull or bear trend, or a bull or bear trend into a trading range. I usually reserve the term reversal for one trend becoming an opposite trend. It's very important to distinguish between minor reversals and major reversals. Minor reversals are just a few bars, 3 bars, sometimes 5 or 10 bars, and it does not lead to an opposite trend. If a pattern is big enough, 10 or 20 bars, it has a much better chance of leading to an opposite trend, and at that point I call it a major trend reversal. A bigger pattern is a major trend reversal. Reversals usually begin with breakouts, even though the breakouts are sometimes very small. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on reversals. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on reversals. A reversal is the earliest entry into a trend. The risk is smaller because you're buying either at the bottom of a bull or selling at the top of a bear, but the probability is low, at least initially. My 80% rule, 80% of the time, if you're trying to break out of a trading range, the breakout's going to fail. I also want to describe a pattern that you'll sometimes hear referenced, a cup and handle pattern. What that means is the market's having a reversal and then a pullback from the reversal. The reversal is the cup and the pullback is the handle. The advantage of entering on the first reversal is that the risk is small. It's the smallest that you're going to have in the entire trend. For example, selling up here. The risk is relatively small compared to the reward. However, the probability is usually lower as well. It's higher probability to trade after the trend has begun, but at that point the stop is further away. Once you see a trend is underway, once you see that the market is clearly always in long, it's never too late to enter. The reversal entry, for example down here or reversal up here, is just one of many ways. There are lots of other good ways to enter a trend. 3 or 4 pushes down, 1 or 1, 2, and 3. So it's a wedge bottom. You can also call it a lower low major trend reversal. You got a bear trend, a bull breakout, a lower low. The earliest entry, it's the reversal setup, either above this micro double bottom or above this bull bar, and you get filled right there. However, there are lots of other opportunities to enter a trend. The reversal entry is the first, but there are always many ways to enter a trend. Here we got a high 2 bull flag and a double bottom. We have a buy climax, a test of the bottom of the buy climax, a reversal up with a good looking bull bar. You can buy above the high of that bar and get filled here. A very strong breakout, a surprise bar. Surprise bars usually have follow-through. You can buy the close. Strong follow-through bar. The odds are we're going higher. An attempt at a reversal. Chances are the reversal will fail after such a strong trend. So traders will buy that low, betting that the bear breakout will fail. A high 2 buy. We traded up here, high 1, and then buy above this bull bar, high 2. Stop down here, stop down here, stop down here. The stop is far away. However, the probability is very high. A high 3, high 1 above this bar, high 2 above this bar, and now we have a high 3 buy, a wedge, 1, 2, 3, wedge bull flag, buy above the high of that buy signal bar, get filled right here. A bull breakout and a small pause, a high 1 bull flag, buy above the high of that bar. Clearly 3 pushes up, 1, 2, 3. The earliest entry for the bears, it's selling with a stop below the reversal bar, outside down, closing on its low. Probability is not yet high. The market might go sideways instead of down. However, the math is good because the potential reward is much bigger than the risk, and that more than offsets the probability. If you don't take that entry, don't worry about it. There are lots of other entries. We have 4 bars down, 3 with bear bars closing on their lows. Sell below the low of this bear inside bar. We have an attempt to reverse up, but we have 6 bars down, 5 with good bear bars. The reversal is probably going to fail. Sell with a limit order at the high of that bar and get filled here. Here we have a bull bar, pullback in a very tight bear channel. You sell below the low of that bar. We have a rally. We have a low too short, double top here and here, or double top here and here with other computers. Sell below the low of that bar. Another double top here and here. Sell below the low of this bar. Another double top or a wedge bear flag. Strong push up, second push up, third push up. Sell below that bar. A surprisingly strong bear breakout. 4 consecutive bear bars. Start selling closes here or here or here. The reversal entry is the earliest entry. Just like on the bottom, the reversal entry is the earliest entry, but not the highest probability. We have a high, higher high. We have a higher low, another higher low. That's a bull trend. And whenever there's a trend and there are pullbacks, you can always construct a channel. The bull trend, it's going up, has higher highs, higher lows. You can always make a channel. To reverse to a bear trend, you need a breakout below the bull channel, below the bull trend line, and then you need to get a series of lower highs and lower lows. Lower lows, lower highs. As soon as there's a break below the bottom of the channel, below the bottom of the bull trend line, bears look for a reversal down from a lower high. For example, here, lower high, major trend reversal, head and shoulder stop, left shoulder, head, right shoulder. After such a strong initial sell-off, the odds are high the first reversal up will fail. You have bulls who did not exit and now are holding a big loss. They're hoping for any kind of a bounce so that they can sell out with a smaller loss. You have bears who did not take the earlier entries and they're eager to sell. They'll sell the first rally expecting at least a second leg down. The result is a lower high after a strong bear breakout usually leads to at least a small second leg. It's a higher probability trade. A bear trend, it has lower highs and lower lows, and it's in a channel. Channels tend to become flatter and broader as time goes on, and every time you break above an old line, you draw a new line. We have a new reversal down, we can draw a new line. It broke above that line, it broke above this line, and then we got a new reversal down, you draw this line. With every piece of additional information, redraw lines. A bull trend has inertia. That means it tends to continue what it's doing. In other words, the trend tends to continue. Most resistance will fail. the market is ignoring resistance and it goes beyond one, and then it looks at the next resistance level, and it usually fails as well. We're starting to reverse up. Very strong breakout above this lower high resistance. Remember, this is a bear trend as long as it's making lower highs and lower lows. If it goes above a major lower high like this, it's no longer a bear trend. It's either a trading range or a bull trend. This is a potential double top and resistance. It's a strong rally. The market totally ignored that resistance. It broke strongly above the double top. It broke strongly above the trading range. We had a double top here, top of a trading range. Maybe it's forming a wedge top. We have one reversal down, a second reversal down. That allows us to draw a line. Maybe it will reverse down at the line. No. The top of the channel, potential channel, it failed, and the market broke strongly above it. We have a measured move target. We have a double bottom, a neckline, and a measured move. The market ignored the measured move target and went strongly above that as well. Potential double top, the market ignored it. I said a strong trend, a strong bull trend ignores resistance. A strong bear trend ignores support. However, all bull trends finally end at resistance, so it's important to keep looking. A wedge, 1, 2, 3. Another way to draw it, 1, 2, 3. So we have a potential wedge top up here. We have a pullback here. This low stayed above this high, so we have a potential measured move up from this high. Here's the bottom of the move. Here's the breakout point. Measured move comes in right there. We have a trading range. A market, when it breaks above a range, often goes up for a measured move. The bottom of the range, the top of the range, measured move. So we have a wedge top and two different measured move projections. And we have a decent sell signal bar. Bear trend. It also has inertia. It also tends to continue to do what it has been doing. If it's going down, it tends to continue down, and support will fail. The bulls hope for a potential double bottom. They started to get it, but we reversed down. Remember, this is a bull trend as long as it's making higher lows. Here we have a major higher low, a strong breakout to a new high, yet the market fell below that major higher low. Therefore, the bull trend is probably over, and the market is then either in a trading range or a bear trend. Initially, it's a trading range and a bear trend, but you don't know which will ultimately prevail. Here, a bear trend prevailed. This is support. It could be a breakout test of this breakout point. It could be a double bottom with this prior low, yet the market broke below it. Another prior low, they bought at this price level. When it came down here, it fell below it. They ultimately bought a little bit below it, but they could not rally it enough to go above a major lower high, so it's still in a bear trend. A wedge bottom at support, a breakout point a little bit below. This theoretically is support, a wedge bull flag. We have a bull trend, a pullback in 3 pushes, 1, 2, 3, testing a prior high, around a 50% pullback of the entire bull trend. So there is support here, and the bulls are trying to reverse up. Yet the market keeps falling through every support level. A wedge bottom, 1, 2, 3, double bottom here, potential support, trying to reverse up. The market continues to fall through support, a bear trend. Potential support here. We have a spike, pullback, second push, third push. It's a spike and channel bull trend, spike, pullback, channel. Usually the bottom of the channel is support. The market fell through that as well. Most support fails in a bear trend. However, all bear trends finally end at support. That means it's important to keep looking for support and then watching how the market behaves at support. Another wedge bottom. We had 1, 2, 3, that bottom failed. We had 1, 2, 3, that bottom failed. And now we're getting a bear breakout below a bear channel. You can call it 3 pushes, 4 pushes, 5 pushes, doesn't matter. 3 or more pushes, it's a potential wedge. And we're getting a strong bear breakout below a wedge bottom. Also, look at the size of this breakout. It's the strongest move late in a bear trend. It's about 50 bars into the bear trend. Anytime you see the biggest bear bars coming 20 or more bars into a bear trend, the bear breakout more likely is an exhaustion gap than a measuring gap. It's more likely the end of a move than the start of a new, stronger move down. Bear breakout below bear channel, 75% chance the market's going to reverse up within 5 bars. The biggest bear breakout late in a bear trend, chances are the market's going to reverse. We had a potential double bottom here, and the market fell below that double bottom. Potential measured move. We're also right above a prior important higher low, the bottom of the entire bull trend. Bulls will try to create a double bottom around that low, and if the bulls are strong, they'll try to keep the double bottom above the prior low and create a slightly higher low double bottom, which it did. We have a bull trend, a reversal attempt, but the trend continued. A bull trend, a reversal attempt, but the trend continued. Anytime you have a reversal attempt in a bull trend and the trend resumes, that reversal attempt is a bull flag. So a bull flag, reversal attempt, but the trend continued, bull flag. There are several things needed for a bull trend to end. The first is you need a break below the bottom of the channel, a break below the bull trend line. And you need the pullback to fall below a major higher low. For example, we have a higher low here with a very strong reversal up to a new high, so it's a major higher low, and yet we broke below it. Once it breaks below a major higher low, the bull trend is no longer in effect. The market's either in a trading range or in a bear trend. I just talked about how in a strong bull trend, most resistance fails. 80% of resistance fails. The market keeps going up. And in a bear trend, most support fails. That's my 80% rule. 80% of reversal attempts in a strong trend will fail. Some traders, they're addicted to reversal trades. They're always looking for reversals. Reversal down, they sell. Reversal down, they sell. When you're selling reversals in a strong bull trend, you can sometimes make money if you're careful about your trade selection and your management, but it's only a scalp. Strong bear breakout below a major higher low. Some bulls will buy the reversal. They'll buy the reversal, break out below a prior low, break out below a prior low. They'll buy the reversal. But when you're in a bear trend and you're buying only for a scalp because most reversals will fail in a strong trend. For example, a bear who sold here, if he did not scalp out, the market tried to go back up here. It went down a little bit more. It's trying to go back up a second time, a high 2 bull flag. Whenever you're in a bull trend, especially a reasonably strong bull trend, and you get a high 2 buy setup with a good looking buy signal bar, the bears get out above that buy bar. And the bulls buy, expecting a resumption of the trend. This is a high 3. The bears who shorted here, if they did not scalp out, they'll get out above either this high 2 or this high 3. This is a surprise bear bar, probably at least a small second leg down. They got it. Some bears would hold short, even though a high 2 triggered here, because this bear bar is so big, probably at least a little bit more down. However, now we have a wedge bull flag. 3 pushes down, 1, 2, 3. Bears will get out above its high. Now we have a bear trend. We have a low 1 short here. Some bulls buy here looking for a scalp. Maybe a reversal up from this low, maybe a 50% pullback from this bear trend, and they'll look to scalp out. around a 50% pullback. However, if they did not exit with their scalp, and now we're getting a low 2 short, low 1 below this bar, low 2 below this bar, and the low 2 sell signal bar is a bear bar, bulls will sell, and there's a high probability that we're going lower. 2 pushes up, bull bars, bear bar, bull bars, and now we got a bear II, a pretty good looking bear bar. Traders will sell below the low of that bar or the low of this bear bar. The bulls will sell because they'll know the odds are high, we're going down, and the bears will sell for the same reason. They have a lower high and a bear trend, a low 2 short with a good sell signal bar, very good trade. Strong reversal up from a wedge bottom. We got 3 pushes up, 1, 2, 3. A low 2 short, maybe we'll get a third push up. This reversal up is strong, the second leg is strong. Some bulls might be willing to hold just in case this wedge bottom leads to a test of the old high. However, we're getting a lower high here. We have a wedge, 3 pushes up, 1, 2, 3, a wedge lower high, so it's a wedge bear flag, and we have a pretty good bear bar here. The bulls who bought here, if they are still holding long, they'll get out below that wedge bear flag. And the bears who are flat will sell it. They'll bet on another lower high and a bear trend. And they'll bet the reversal attempt will fail, and they'll see this as a wedge bear flag with a good-looking sell signal bar. A lot of traders like to take trades where the reward is much bigger than the risk, at least twice as big as the risk. Whenever you have a very strong risk-reward profile like that, a reward twice as big as the risk, you always have a relatively low probability. There has to be a reason for some institution to take the other side of your trade. If you have very strong risk-reward, you have to have lower probability because that institution who's taking the other side needs something. If they have bad risk-reward, they have to have pretty good probability. Reversal trades in general are low probability trades, but the stop is not far, so the risk is small, and you might be entering at the beginning of a big trend, so the reward is very big. Very big risk reward, very strong risk reward. Reward much bigger than risk, but the probability is only about 40% when you have a good looking reversal setup. However, the reward being so much bigger than the risk more than offsets the relatively low probability, and the trade is still good. For example, the bears are sold here. The risk is small compared to the reward. Probability, not all that high. More likely, we're going to go sideways. Yet, we went down a long way, and it became a very good trade. Some bears would take their profits here. We have a wedge bottom and a higher low compared to the original bull trend. Others will take their profit here after a huge sell climax. In either case, the reward for the bears here or here is many times bigger than their initial risk. Some traders want to trade reversals, but they want higher probability. Those traders wait for the strong breakout into the new trend. At that point, the probability of profit is 60%, sometimes even higher if the breakout is strong and the context is good. For example, this is a low risk trade with lower probability. Stop above the high of the sell signal bar. Yet, if you sell here after 2 big bear bars closing on their lows, or here at the bottom of a 6-bar bear micro channel, or here, you have a higher probability of making money, but your stop is still up here. The risk is greater, and there's less profit potential remaining in the trade. So smaller reward, greater risk, and that always accompanies higher probability. Whenever you're waiting to enter later, once the probability is higher, you're always going to have a worse risk-reward profile. Because if you're having a high probability of profit, the institution taking the other side of the trade needs good risk-reward, which usually means the stop is further away. If you wait to enter when the probability is high, usually the stop is further away. It doesn't matter whether you take the lower probability early entry or the higher probability later entries. Both have positive traders' equations and therefore are good trades. Remember, there are no perfect trades. At least one variable has to be bad, even for the best trades. Risk, reward, probability, you cannot have all three in your favor. There's no such thing as a high probability trade with very low risk and very big profit potential. That cannot exist, because as soon as a trade started to approach perfection, everyone would take it and there would be no one left to take the other side of the trade, and the trade would fail. I'm going to talk now a little bit about the cup and handle pattern, where you have a reversal that's sometimes referred to as a cup, and then a pullback from the reversal, and that's sometimes called the handle. Whenever there's a reversal, eventually it'll have a pullback, and that creates a cup and handle pattern. The market sold off strongly and then reversed up strongly. And then it pulled back and it tested the breakout at the top of this trading range. This is what traders sometimes call a cup and handle pattern. This is a cup and the pullback is the handle. The reversal is the cup and the pullback from the breakout is the handle. And you can see it looks like a teacup, a cup, and a little handle. Traders look either to buy the reversal up initially, the breakout, or the pullback from the breakout, the handle. They'll buy above the bull bar, looking for what they hope is a trend up. It's often also a higher low major trend reversal. We have a bear trend, a bull breakout, and a higher low. There are also upside down cup and handle patterns when you get a reversal down from a high. Here we have a strong trend and a strong reversal down, and we get a pullback. Therefore, this is a cup and a handle pattern. You could simply call it a reversal, a lower high major trend reversal, head and shoulders top, left shoulder head, right shoulder. Doesn't matter what you call it. The market's reversing strongly down and it's pulling back. Traders will look to sell with a stop on the breakout below the pullback. They now see this as a bear trend and this pullback as a bear flag. A reversal is the earliest entry into a trend. And when you're entering on a reversal, your probability is less, but so is your risk. And therefore, the better risk-reward ratio compensates for the lower probability. My 80% rule, 80% of the time, if the market is in a trend and is trying to reverse, the reversal will fail. Likewise, if it's in a trading range, 80% of the time, if it tries to break out, the breakout will fail. And finally, I talked about a cup and handle pattern. A cup and handle pattern is a term you'll sometimes hear, and all it means is that you have a reversal, which is sometimes called the cup, and then a pullback from the reversal, which is sometimes called the handle. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on reversals. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on reversals. I think it's important to understand that beginners particularly love reversals, and that is because beginners only think about risk. Their accounts are small, and they're terribly afraid of losing money. If they lose their account, they may lose their dream of being a professional trader. And because of that, they're always looking for trades that have the smallest risk, and that usually means that they're looking for reversals. However, they totally ignore the other 2 variables, probability and reward, and usually a trade that has low risk has low probability. In other words, you lose most of the time. I want to talk a little bit about buying and selling pressure, the earliest signs that one side might win. And finally, I want to talk about a nested pattern. That is a pattern within a larger pattern of the same type. For example, you might have a small wedge forming the third leg of an even larger wedge. A beginner has a small account, and he worked really hard to save money to create that account, and he's very afraid of losing that money. Therefore, when he's trading, he usually always focuses on risk. And the result is he's often seeing reversals instead of strong trends. Here we have a very strong bull breakout, and the beginner thinks, okay, second entry short, here's a first entry, here's a second entry. Maybe this is really part of a trading range. If I sell below this bar, my stop is right here. I'm not risking much, and I might make a reward all the way down to here, far greater than the risk. He's ignoring probability. After a strong reversal up and then a strong breakout like this, the odds of this being a profitable short are small. Probably the reversal will fail and create a bull flag and then be followed by another leg up. The sell signal bar, it's not very big, so if a trader sells below its low, he gets filled right here, and his stop is right there, so the risk is small. However, whenever your risk is small, the probability of making money is usually small, which means the probability of losing money is high. The beginners, they see reversals everywhere. They're constantly seeing wedge tops and strong bull trends, ignoring the strength of the trend and the low probability of the reversal. The beginner is so eager to sell that he does not wait for a trend line break. For example, here's a bull trend and a trend line break, and he sees reversals everywhere. He's constantly trying to sell in strong bull trends, and he's constantly trying to buy in strong bear trends. He's selling before there's any significant selling pressure. 3 bear bars, but small, prominent tails below, and the size of the bear bodies is small compared to the size of the bull bodies here and here. Very little selling pressure, so very little chance that the bears will win, even though you might say this is a wedge, 1, 2, and 3. Low probability bet, and that is usually what you get when you take a trade that has very little risk. When a breakout is strong like this, 3 consecutive bull bars closing at or near their highs, the odds are high that you're going to get at least a second leg up. This could be the second leg up, but probably we're going higher. If these bear bars closed on their lows, then maybe this would be the end of the move, but with the big tails below the bars and the bear body being small here, the odds are any reversal attempt will result in a bull flag and lead to at least one more leg up. It's too early to sell. A beginner is always wondering how he can possibly be losing money when he's working so hard to reduce risk. It's because he's fighting a trend, and structuring trades that have bad meth, you're going to lose money. The beginner pretends that probability does not exist. He's going to take the trade because the risk is small and the reward is big. Great risk reward. If he watches a financial show on television, all he hears them talk about is risk reward. And he looks at this and says, well, my risk is small, my reward is huge. That's fantastic risk reward and therefore a good trade. What he does not realize is on television, they always talk about risk reward. They rarely ever talk about probability. And that is as important as risk and reward when it comes to the trader's equation. He also thinks that if taking one trade is good, taking 10 trades is better. So he's constantly looking to take a lot of trades. He's constantly selling anything that looks like a reversal in a bull trend, and he's constantly buying anything that looks like a reversal up in a bear trend. A reversal, a failed breakout, a lower high, it's a sell. He sells. And then he gets stopped out. A second entry reversal, wedge, 1, 2, 3, failed breakout of a trading range, it's a sell. And you get stopped out. Here we have a double bottom, slightly lower low double bottom, a breakout test, a test of the breakout above the trading range, it's a buy, ignoring how tight the channel is. And he gets stopped out. He buys again, a wedge bull flag, 1, 2, 3. And he gets stopped out again, ignoring that this reversal is occurring in a fairly tight bear channel here and within a larger bear channel here that is also fairly tight. It's a low probability buy. Minor reversal, the best the bulls probably get is a trading range. Again, another reversal, this time another wedge, 1, 2, 3. The last wedge was 1, 2, 3, and now he sees a new wedge, 1, 2, 3. He ignores a bad-looking buy signal bar. He ignores these two big bear bars. With that other big bear bar, all he sees is a wedge and a higher low. Must be a wedge bull flag. He gets stopped out again. And all of these losses are relatively small. However, if you get a lot of them, they add up to a very big loss. It's like bleeding to death from 1,000 paper cuts. He's trying to avoid risk. He's trying to take low-risk trades, and he is. However, the probability is also low, and if you lose frequently with low-risk trades, that low risk adds up to a lot of risk by the end of the day, and the beginner loses a lot of money taking low-risk trades. The beginner knows this is a bad short. He knows this is a bad buy. He doesn't care. He knows the context is bad, but he's just focusing on one thing, risk. He does not want to risk very much on every trade. At some point, he loses so often that he expects to lose on every trade, yet he feels like he has to trade because that's what traders do. They keep trading. However, if traders keep trading using a certain style of trading and they lose repeatedly, they stop. But beginners don't stop. They know that all they have to do is just get a little bit better and they'll make money. But that's not true. Selling in a strong bull trend or buying in a fairly strong bear trend, you're going to lose. Even if you lose very little, you're going to lose often. And ultimately, you'll lose everything in your account. Whenever you take a trade and you feel hopeful, oh boy, I hope this one works. I really need this one to work. I've been losing all day. I really hope this works. That immediately tells you that the probability is low. Whenever you need hope, you're taking a trade that is probably going to lose money. Another problem that beginners face is they lose so often, they're taking low probability trades. That means they're probably going to lose, and that means they lose often. When they finally get a profit, they take it immediately, they scalp, forgetting that they need a big profit to offset all of their losses. So not only are they taking low probability trades, losing often, when they finally get a profitable trade, they scalp. Whenever you take a low probability trade, you need a very big reward to offset your low probability. That means you need a swing trade. However, the beginner is so desperate for a win that he takes a quick profit and scalps. And that's a losing strategy. If you have a low probability trade, a low risk trade, low probability trade, you need occasional very big wins to offset all of those losses. And beginners just can't do it. They're so happy to finally not have a losing trade that they take a quick profit. And that is a losing strategy. You cannot have small profits if you're taking low probability trades. The beginner who is selling, and losing, and now sells and has a winner, he's really excited. He's selling a wedge top, and he finally has a winner. But he saw the last two times he had winners, and they quickly turned into losers. He sold here. He had a winner. It quickly turned into a loser. The beginner takes his profit right here. He scalps out. He's so afraid to lose. Low probability plus low reward is a losing strategy. It's a negative trader's equation. If you're going to take that trade, you have to be swing trading. You need an occasional big win to offset the frequent small losses. So to get a positive trader's equation when you're taking a low probability trade, you need a big reward. You have to be swing trading. Well, here's another example. We have a bull trend. Lots of wedges. 1, 2, 3. You can keep drawing wedges all day long. 1, 2, 3. Maybe 1 or 1, 2, 3. Failed breakout above a high. The second entry short. Maybe a wedge. 1, 2, 3. Second entry short here. Yet they're all losers. However, the beginner says, well, the risk is not big. If I sell here, my stop is here, I don't lose much. If I sell here, my stop is here, don't lose much. Sell here, don't lose much. But if you keep losing all day long, those small losses add up. Low probability trades, that means you're going to lose most of the time. Even if you lose a little, lots of little losses adds up to a big loss. You keep getting stopped out all day long, and your low risk strategy results in a very big loss at the end of the day. And like I said, when you finally do win, you will not make enough to offset all of your losers because you'll probably scalp. And if you're taking a low probability trade, you need big reward. A low probability trade goes hand in hand with a swing trade. If you're looking for scalps, you have to take high probability trades. Shorting in a tight bull channel is not a high probability bet. Skilled traders see these same reversals, but they're not shorting. They're waiting for them to fail and become bull flags. They're buying the reversal up. They see the reversal down. They expect rather than a reversal and a bear trend, it'll fail and become a bull flag. Reversal, they'll buy. Reversal, they'll buy, and they'll put a stop down here. Reversal down, they'll buy the reversal back up. Reversal down, they'll buy the reversal up, and they'll put a stop down here. High probability, the risk is bigger. If they're buying up here, their stop is here, but the probability is very high, and they have a much better chance of making money taking a trade that has bigger risk because it has much higher probability. I want to talk a little bit about buying and selling pressure, the earliest signs of whether the bulls or bears will win and create a breakout. If you're looking for a major reversal, that means you're looking for a big move, 2 legs, maybe 20 bars. That usually does not come from a small pattern. For a trend reversal, you need buying pressure. If you have a bear trend, you need buying pressure. And you can get that from 2 very big bull bars like this, closing on their high, but you can also get it from 10 smaller bars. This is enough buying pressure. You have a bull bar, big bull bar closing on its high. You have an even bigger bull bar closing near its high. This is enough buying pressure so that traders will look to buy a reversal up from the next sell-off, a possible high or low major trend reversal. This initially is probably a minor reversal. The low is only 1 bar low. However, if you get enough buying pressure in that minor reversal here, and this is probably a minor reversal as well, it can lead to a major reversal on the next big move down. Minor reversal, probably going to lead to a trading range. However, it creates enough buying pressure, strong breakout above the bear channel, and an even stronger breakout. The next reversal down might fail and lead to a major trend reversal. A double bottom, higher low, major trend reversal, and it led to a swing up. Here we have a pair of bull bars, another bull bar, 2 to 4 small bull bars. Here we have 3 bars up. It's just not enough buying pressure to reverse a bear trend. Any reversal up is probably minor. The bulls need more big bull bars before they can get a major reversal, a reversal into an opposite trend, instead of a minor reversal into a bear flag or a trading range. Remember the market cycle. A bear trend usually transitions into a trading range before you can get a bull trend. While in the trading range, the bulls can create enough buying pressure so that eventually there will be a successful major trend reversal and a bull trend. So that eventually there'll be enough buying pressure so that there'll be a major reversal and a bull trend. Bear trend evolved into a trading range, maybe a double bottom, slightly higher low major trend reversal. The bulls are beginning to get big bull bars closing on their highs. That is buying pressure, and it increases the chances that the bulls eventually will be able to get a bull trend. Higher low major trend reversal. Bulls can buy with a stop above the high of that bull bar, and then a protective stop below here. Again, if a reversal lacks pressure, the reversal is probably minor. 3 bear bars, 4 bear bars. Is that enough for a major reversal? Probably not. The best the bears probably get is a trading range. More likely they get a bull flag and the bull trend will resume. Is this a higher high major trend reversal? This is probably not enough selling pressure. The bull trend probably will have to transition into a trading range. And during the trading range, the bears can accumulate a lot of bear bars. After that, they have a chance at a major trend reversal. Not enough selling pressure, sideways more likely than down. Minor reversal, probably into either a bull flag or a trading range. We have a bull trend, we have a minor reversal here, another one here, and this one is probably minor as well. I would not call it a significant wedge top because the legs down are small. Probably going to result in 2 sideways legs instead of a big bear trend. One sign of selling pressure is a significant break below the bull trend line, which we have here. It came from a series of small bars, but it came from a lot of bars, and it broke far below the bull trend line by going mostly sideways, but that's all the traders need. At this point, you look back and say, well, not much selling pressure, but it tends to accumulate. And now we have a break far below the bull trend line. After the bull trend resumes up, traders look for a failure in the neighborhood of the old high, and then a major trend reversal. For a bull to bear reversal, usually you need some selling pressure first, and it usually comes during the formation of a trading range. So bull trend and then trading range, it began here. And then after there's a trading range, the bears can accumulate enough selling pressure to take control and form a bear trend. Bull trend weakened, still a bull trend, The trading range probably began with this pullback. The market transitions from bull trend into trading range and then into bear trend. And the trading range often begins before the final high of the bull trend. This final part is a bull leg and what will become a trading range. The bears begin to accumulate selling pressure, and at some point they're strong enough to take control of the market. For example, here we have a lower high major trend reversal. A wedge lower high, 3 pushes up, 1, and then a bear bar, and then 2, and a bear bar, and then 3. A wedge lower high major trend reversal, 40% chance of a swing down. Reasonable trade, reward much bigger than risk, 40% probability. That's what the probability usually is for any major reversal. But the reward is at least twice the risk, and therefore the trader's equation is positive. I want to finish by talking about nested patterns, a pattern that is within a larger pattern of the same type. The nested pattern usually is in the final leg of the bigger pattern. Sometimes it can be bigger. Sometimes it can occupy 2/3 of the bigger pattern. 3 pushes up from a low, 1, 2, 3. So this is a wedge rally. and it's within a larger wedge. 3 bigger pushes up, 1, pullback, 2, pullback, 3, where the third subdivided into a wedge as well, 1, 2, 3. So we have a smaller wedge within a larger wedge, and therefore this is a nested wedge pattern. It has a higher probability of a reversal. If you were to look at a smaller time frame chart, this would in fact be a big pattern. For example, if this is a 60-minute chart and then you flip to a 5-minute chart, this would be a pretty big pattern. 4 hours down, 4 hours, 3 or 4 hours down. So the smaller pattern is always a bigger pattern on a smaller time frame chart. Two or more different time frames trying to do the same thing, higher probability of a profitable trade. Look at this, 3 pushes down, bear bar, bull bar, bear bar, then tail for the second push down, and then we have a third push down here. We have a wedge bottom, very small, minor on this time frame. If this is a daily chart, this could be a 5 or a 6 day wedge bottom on a 5-minute chart. Slightly bigger pattern, this small wedge, 1, 2, 3, is within a larger wedge, 1, 2, 3. And here's a larger wedge, 1, pullback, 2, pullback, 3. Within a larger wedge, 1, 2, 3. Within a larger wedge, 1, 2, 3. So we have several layers of nesting within a large wedge bottom. And then we have a good buy signal bar here, a higher probability that you'll get at least a couple legs sideways to up. When you have many ways to draw the same pattern, then the market's trying to reverse at the same price on many different time frames. Most computers will see at least one version of the wedge, and that means most computers will be looking for a wedge reversal, and if all of the computers are looking to buy, there's a higher probability that the reversal will come. The probability is especially good when there's a strong buy signal bar and when it's the same buy signal bar for every way you can draw the wedge bottom. When the market's in a trading range, most reversals result in legs within the trading range. The end result is a big trading range, not an opposite trend. Higher low major trend reversal, but a lot of trading range price action here and all the way down here. Big bear bars, bad follow through, tail, bad follow through. The rally up, big tail on top, bear bars. This looks like trading range price action. Even though this is a major trend reversal, it's probably going to result mostly in a big trading range. Higher low major trend reversal, bull trend, but bad follow through, bad follow through, bad follow through, bad follow through. This is probably going to be a bull leg in what will become a trading range, and therefore traders will look to sell a pattern near the high, and we have a wedge top. However, there are 2 ways to draw the wedge top. 1, 2, 3, and 1, 2, 3. So it's a nested pattern. First push, second push, and third push subdivides into a smaller pattern. Also, a measured move projection. We have a break above a trading range. Traders are looking for a measured move up, and they expect profit taking and resistance. Also, we're testing a prior high, so some profit taking there as well. Bears will look to short. Bear bar closing on its low. Bulls will take profits. Aggressive bears will sell. Whenever you have a major trend reversal, here we have a bear trend, bull breakout, higher low, major trend reversal. 40% of the time, you'll get a swing trade like this. And most of the time, the swing trade results in a big trading range. It evolves into a trading range. Only 20% of the time, you get a big trend out of a major trend reversal. you can get the end of the bear trend. 40% of the time, you'll get a swing up. 20% of the time, the swing will become a big bull trend. But 40% of the time, you get a swing up and then the evolution into a big trading range. A trend, here's a bear trend. It usually is followed by a trading range. It was followed by a trading range here, and ultimately even a very big trading range here. Usually a bear trend is not followed by a bull trend is not followed by a bear trend. At best, you usually get a swing, 20, 30, 40 bars in the opposite direction. A bear trend or swing with bad follow-through looks like a bear leg in a trading range. Again, a bear trend or a swing. We're staying above the lows over here, staying below the highs over here. That means this bear trend is simply a leg within a big trading range. A bull trend, not consecutive big bull bars closing on their highs. We had a couple here, but bad follow-through, and then bad follow-through here. A bull leg in what became a big trading range, not a bull trend. I began by talking about how beginners love reversals because all they see is risk, and they ignore the fact that whenever you take a trade that has very little risk, it usually has very little probability of success, and that means you lose most of the time, and it's usually a bad strategy. I then talked about buying and selling pressure. If you're going to get a trend reversal, let's say you have a bull trend and you're looking for a bear trend, it usually will not become a bear trend until there is some accumulation of selling pressure. Likewise, if you have a bear trend and you're looking for a reversal up, you usually need some buying pressure before the reversal takes place. And that buying and selling pressure usually comes during a trading range. Usually the trend has to transition into a trading range before it becomes an opposite trend. I finally talked about nested patterns, where you have a pattern within a larger similar pattern. When you find a nested pattern, you have a higher probability of success. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on reversals. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on reversals. I think it's important to realize that most major reversals are successful only 40% of the time. 40% of the time you get either a swing trade or a trend. 60% of the time you either get a trading range or a continuation of the prior trend. When I'm looking for a reversal, my minimum objective is 10 bars and 2 legs, TBTL. Most major reversals, even wedges, have a double top or a double bottom involved with them. I said that 40% of reversals lead to a major reversal, a swing in the opposite direction. 60% are small winners or small losers, and they essentially offset one another. We have a bull trend. The market went sideways to break below the trend line, and now we have a higher high. It's also an expanding triangle. Up, down, more down, up, and a decent sell signal bar. So it's reasonable to sell this as a higher high major trend reversal. All expanding triangle tops are higher high major trend reversals. A trader who took that trade, if he held through this, he got stopped out right here with a small loss. Now we have a wedge. 3 pushes up, 1, 2, 3. I do not have the bull trend line drawn in, but it's a wedge with a wedge shape. We have a micro double top, reasonable sell either below that bull bar or below this bear bar. The market did not fall quickly, and traders would exit with a small win at the end of the session. the small loss here, offset by a small win here. In the E-mini, if you're looking for a swing trade, a major reversal is a swing trade. You want the reward to be at least 2 times your risk because your probability of success is only 40%, and you need at least a reward twice your risk to make the trader's equation positive. So for example, if you're risking 2 points, you have to be trying to make 4 points. Here we have 2 attempts at a top. Here, higher high major trend reversal. Here, a wedge. After 10 similar trades, you might have 4 winners with 4 points each for 16 points, and maybe 6 losers, 2 points each for minus 12 points, usually less, and your net profit would be 4 points. So if you take 10 trades, you would end up with a profit. I think the math is actually better than this, but I'm just giving this as an illustration of more or less a worst case outcome. If you take 10 reasonable major trend reversals with good setups like this, the odds are you're going to end up with a profitable basket of trades. Let me talk about a Forex trade where you're looking for a major trend reversal. You want a swing trade. A minimum swing trade in the Forex market is probably 40 pips, and let's say you have to risk 20 pips to take the trade. And let's say you took 10 trades similar to this. Here we have a higher high major trend reversal, and now we have a wedge top. If you took 10 comparable decent setups with decent signal bars, after 10 trades you might have 4 winners that led to a swing trade, 40 pips. So 4 times 40, you'd have a total of 160 pips profit on your 4 winners. And your 6 losers, if you lost the full 20 pips, you'd lose a total of 120 pips. And your net for the 10 trades would be a 40 pip profit. It actually would be better because you probably would lose less than 120 pips on the 6 losers, because the 6 losers probably would not be 6 losers. It might be 3 small losers and 3 small winners. But in any case, if you took 10 trades and they had reasonable setups, the odds are that you would probably end up with a profit. The math is actually better than what I just said. Here's the E-mini. When I said 6 losers, I did not mean 6 losers. I meant 6 trades that did not achieve a swing profit. And those 6 losers are a combination of small losses and small wins that balance each other out. And the probability of winning is often more than 40%, and some trades go for much more than 4 points. We have a bull trend and a bear break below the bull trend line. You can call it a wedge, 1, 2, 3. And you have a small lower high major trend reversal, or you can call it a small double top in a tight trading range. You can call it a double top right here in a tight trading range. And you look at a tight trading range like that, and you have a good sell signal bar, there actually is a 40% chance you're going to get a swing down, 2 legs down, 1 pullback 2, or 1 pullback 2. So it's a reasonable setup. Your stop is not far above, and if you held all the way down here, your reward would be much, much bigger than 2 times your risk. In this particular case, if you held all the way down here, you would have exited with 18 points profit, which is far more than twice your initial risk. And some of your winners will be very big like that, and they'll more than offset the small losses. This is the euro versus the dollar, a 5-minute chart. We have a bull trend and a bear breakout, and then we entered a tight trading range. And within the tight trading range, we have a double top, good sell bar here, good sell bar here. It's a reasonable trade. When you have a double top, lower high, major trend reversal in a tight trading range, there actually is a 40% chance of 2 legs down, 1 pullback 2 or 1 pullback 2. And in your basket of 10 trades, you probably will get at least one that looks like this. When I said if you take 10 trades and you'd have 6 losers I did not mean that. I meant you'd have 6 trades that were not swing trades of 40 pips or more. And most of those losers are small wins or small losses that balance each other out. 40% of the trades will result in a profit of at least 40 pips. Let's say you sold this as a lower high major trend reversal, or this as a double top lower high major trend reversal. A tight trading range with a double top lower high in it is a 40% bet that you'll get at least 2 legs down. A decent sell signal bar here, decent sell signal bar here. This is a reasonable trade. Even if you took this short, this did not hit your stop. So this short, you're still short here. If you exited at the end of the session, you would have had 90 pips profit. That more than offsets the risk. And if you take 10 comparable, reasonable major trend reversals, you will get 1 or 2 that have exceptional profits. And that is why trading major trend reversals is a good thing to do. The 40% of the time when you do get a swing profit more than offset the 60% of the time when you do not. The minimum objective when you're looking for a reversal, 10 bars, 2 legs. It can be more than 10 bars, it can be more than 2 legs, but this is a minimum reasonable objective. Any kind of reversal or any kind of a big move, a breakout, a climax, a reversal, the minimum objective is TBTL, 10 bars, 2 legs in the opposite direction. For example, here, we got a higher low major trend reversal, minimum objective, 2 legs up, 1, pullback 2, and 10 bars. So this obviously is much more than that. You can also say it's more than 2 legs, 1, 2, 3, 4, 5, depending on what you want to call a leg. Higher low major trend reversal, a bull bar, slight micro double bottom, second entry, reasonable buy, stop goes below the bottom of the higher low. Do not get stopped out here, and the swing continued up. A trading range, a bull breakout, measured move up, and now we have a wedge, nested wedge actually, 1, 2, 3, and 3 subdivides into 1, 2, 3. A decent bear bar, a good location to get out, especially since it's at the top of a larger trading range. You could draw the measured move up using this high instead of that high. Some computers will use this high, others will use that high. If you used this high, the pink line, it did not quite reach there, but we still reversed down and we still have a wedge and we're still testing the top of the chart. Good to get out below the low of that bar. This is the euro versus the dollar, and it's a 15-minute chart, and it's a broad bear channel. Lots and lots of minor reversals, lots of major reversals as well. In general, when I'm trading, I look at the highest time frame that shows the pattern. We have a wedge bottom, 1, 2, 3 on the 15-minute chart. And you expect 10 bars and 2 legs up. But is it 10 bars on this time frame or 10 bars on the highest time frame that also shows the same pattern? If you're looking for 10 bars and 2 legs, you have it right here. However, the pattern is so big, it's probably also a wedge bottom on a higher time frame chart. I want 10 bars, 2 legs up on the highest time frame chart that shows the pattern. In this particular case, we have, 50, 100 bars here, 50, 100 bars here. I'm going to take a look at a higher time frame chart to see if there's also a good wedge. Here is the 60-minute chart of the same bars, and it also has the wedge bottom, 1, 2, 3. I'm going to look for 10 bars and 2 legs up on the 60-minute chart, not just on the 15-minute chart. On the 15-minute chart, this was the end of the 2 legs up. On the 60-minute chart, it went higher, and the second leg up is over here. You'd make an additional 30 or 40 pips if you set your target based upon the 60-minute chart. 10 bars and 2 legs on the 15-minute chart ended right here. It's only part of one leg up and only 3 bars up on the 60-minute chart. Yet the pattern is still obvious on the 60-minute chart. So I have to be setting my target based upon the highest time frame that clearly shows the pattern. And that's the 60-minute chart. So 2 legs up, 1 pullback, 2. Minimum objective, 2 legs sideways to up, so either here or here. If you're looking at a 15-minute chart and you compress the bars so that you have a lot of bars on the screen, you see a broad bear channel and 3 pushes down, 3 or 4, 1, 2, 3, 4, or 1, 2, 3. It's a wedge bottom, and we have a small final flag here and a reversal. However, I want to look at a 60-minute chart. This pattern is maybe 100 bars, 200 bars. Maybe the same pattern is present on the 60-minute chart, and it is. That's what we see over here on the 60-minute chart. So I'm going to set my objective based upon the highest time frame that shows the pattern. This is the 15-minute objective, 10 bars, 2 legs, and it was achieved here. The 60-minute chart actually even got a larger 2-legged pattern, 1, pullback, 2. Here's the wedge bottom on the 15-minute chart, also present on the 60-minute chart. I'm going to look for the target based upon the 60-minute chart. All trend reversals begin with a breakout of the channel. Bull trend, bull channel. For a reversal, I need a breakout below the channel. Bear trend, bear channel. For it to reverse into a bull trend, traders need a breakout of the bear channel. We have a bull trend line for a bull trend, and traders need to see a pullback that breaks the bottom of the channel, in other words, the bull trend line, and preferably it has to be strong enough to get down to the 20-bar exponential moving average. You want some sign of strength on the part of the bears before anticipating a reversal into a bear trend. Next, after the break below the channel, you want the bull trend to resume and to reverse down a second time. Once we got near the old high, we have a second pullback that began, but the pullback kept growing and became a reversal into a bear trend. A lower high major trend reversal. All major trend reversals are types of double tops. Here it's a lower high double top and a strong reversal down into a bear trend. Bull to bear trend reversal. You need a break below the trend line, and then you need a test of the old high, and then a second reversal down. Here we have a bear trend reversing into a bull trend. You need a break above the bear channel, and then a resumption of the trend down. Here we resume down twice, and then you got to see a reversal up from there. We have a higher low major trend reversal, and now we have a double bottom higher low. So it's a double bottom higher low major trend reversal, and it led to a bull trend. Most reversals are double tops or double bottoms, or some variation of a double top or double bottom. And that's even true with wedge reversals. There's usually a double top or a double bottom involved. Lower high major trend reversal, but it's actually a type of a double top. Higher low, it's a type of double bottom. And then we have an additional double bottom here. Since reversals involve some kind of a test, most reversals are double tops or double bottoms. I talk about this more in the video on major trend reversals. Again, this is a double top, but a slightly lower low double top, so it's a variation of a double top. And here we have a double bottom here, and a double bottom there, and then a small double bottom higher low here. Again, double bottoms. A bear trend, and then a test of the bear trend, here and again here, creating some kind of a double bottom. And the bear trend fails to continue down, and the market goes in the opposite direction. The bull trend tried to resume, but it failed a second time, creating a double top, and that led to the reversal. Double tops and double bottoms, they're rarely perfect, and a lot of times they're not all that obvious. A lot of times they're distorted, and it's difficult to see them. And a lot of times traders will describe them by some other term, like a major trend reversal, a failed breakout, a final flag reversal, or a wedge. But there's still a double top there or a double bottom there if you understand what's going on and you know what to look for. A double top may not look like a double top because the two highs are not at the same price, but that's a double top. The bulls tried to resume the trend and they failed around the same price as they failed previously. Another double top with these two highs or this high and that high. Doesn't matter. Some computers will say it's a double top with this. The bull trend tried to reverse and it failed again around the prior high and reversed down. So it's a double top. A small double bottom and a micro double bottom here, this low and that low. Micro double bottom and a small double bottom. A double top with a micro double top. Double top bear flag led to a trend resumption down. The bear trend resumed, but it failed to continue. It reversed up. So we have a bottom and a second bottom. It's a double bottom. Even though this bottom is slightly below that bottom, it's still a double bottom, and it led to at least a minor reversal. The bull trend tried again to begin, and it failed around the price where it failed earlier. Slightly lower high, but it's still a double top, and since it's in a bear trend, I call it a double top bear flag. The bear trend resumed, but reversed up around where it reversed up previously. It's a slightly lower low, but it's still a double bottom, and it led to a reversal. The bears again tried to get a double top with this high or that high, or this high and that high. And the bears tried to get a reversal down, but this bull breakout was too strong, and this became a pullback from this breakout, and then ultimately led to a successful breakout above the top of a 50-bar trading range. Small double top here, and it became the neckline of a head and shoulders bottom. Left shoulder, head, right shoulder. The double top bear flag failed. It started to go down, but immediately reversed up. Just like this double top failed. It started to go down, but broke to the upside. This is a double top with this high or that high, and a double top with this high or that high. Some computers will use any of these tops. The basic point is it's a type of double top, but it failed. This is also a double top, even though this high is much above that high. And this is another double top. Again, a higher high double top, but a double top. The market tried to go up and reversed down around the same price as it reversed down previously. Although when you look at these double tops and double bottoms, you might not think of them as double tops and double bottoms, but the computers do. They see two attempts to go one way, both reversing around the same price. Double tops, double bottoms. And that's how you should see them as well. Strong reversal up, wedge, 1, 2, 3. We sold off strongly and reversed up just as strongly. Odds are we're going to get at least a small second leg sideways to up. Maybe a sideways leg here, pull back, maybe a second leg up here. Bear trend, decent bull breakout. We're still in the bear channel. You can say we're still in the bear channel, but it's a pretty strong reversal, and it's a third reversal up. 1, 2, 3. So it's a wedge bottom. Possible triangle final flag. Bear breakout, usually the final leg of the bear trend. A triangle late in a bear trend usually becomes the final flag. Even with a strong breakout like this, you have to assume the market will come back to the apex of the triangle. Strong enough breakout probably will get a second leg up. Bulls put a stop below the low and they hold. They look to buy more above a bull bar here or here or here. A second entry buy, 1, 2, looking for a second leg up. This higher low is a test of the prior bear low, and it's also a pullback from this first leg up. Higher low, expect a second leg up. Even stronger reversal up. This is much stronger than this. It's a possible second leg trap, but probably strong enough so that whatever sell-off we get, it'll stay above that low and be followed by at least a small second leg up. It's a bigger, higher, low major trend reversal. We have a bear trend, a breakout not completely out of the bear channel, but higher, low major trend reversal. Now we have a bear trend, clearly a strong breakout far above the top of the channel. Traders will look at any reversal down as likely to fail, and they'll buy a reversal up. Strong bear breakout, first reversal up, a lot of traders will take a second entry here. We have a breakout of this bull flag, and traders will buy above this bull bar, a pullback from this breakout. Strong bull breakout. The bulls don't mind the strong sell-off. They're expecting the sell-off to fail and form a higher low, and they hope it'll be the first of many higher lows and the start of a bull trend. Another higher low here. Here we have a lower low major trend reversal, and you expect 2 legs up. After you've had the first leg up and you get a higher low, you expect a second leg up, like in the prior slide. In this slide, we have a lower low reversal, so you expect 2 legs up. Remember, when you have a reversal, you expect 2 legs up. If the reversal comes from a lower low, you expect 2 legs up from there. If the reversal begins with a higher low, you expect only 1 more leg up. Lower low, major trend reversal, bear trend, pretty good reversal up. And then we have a couple legs down to a lower low. We have a micro double bottom and a bull bar. It's a reasonable buy, looking for 2 legs up, 1 pullback, 2. That's the minimum objective. Minimum goal for all bull reversals is a swing up. A swing up, you want at least TBTL, 10 bars, 2 legs. And we have more than 10 bars and we have 2 legs. The minimum objective has been met. It's a swing trade. In general, it's good to take off half of your position at 2 times your risk. You buy here, initial risk is here. This is 1 times your risk, that's 2 times your risk. It's reasonable to take half of your position off there and then swing the rest. Stop is down here, below the bottom of your signal bar. After this strong breakout, this then becomes a major higher low. After this strong breakout, this is the major higher low. After this breakout, traders move their stop to just below this low, the most recent major higher low. Here, I'm talking about initial risk. The math is actually based upon actual risk. I talk more about this on the video on actual risk. If you buy above this bar, the market went right up. Your actual risk was probably only somewhere down here, maybe slightly below this bar, less than the initial risk. The actual risk is so small that 2 times actual risk is not a big enough target when you're looking at a pattern this big. So minimum goal, I would base it upon initial risk, and I would expect more than that because even 2 times the initial risk is not very big. Probably going to get more than 2 times the initial risk, but that is a reasonable initial target. After you've had your 2 legs up and you're more than 2 times your initial risk, you have to be looking for reasons to take profit. And here we're fairly high up. We're testing the lower highs in the bear trend. Those are all targets. bulls will take profits around there. And if you get a reversal down, especially a second reversal down with a bear bar, it's reasonable to take profits on your longs from down here, expecting that the bear trend ultimately would evolve into a trading range and that the bull trend would be a bull leg in that trading range, and it would probably stall around one of the prior lower highs in the bear trend. Nested wedge, strong breakout, second push, third push, and we have a smaller wedge here. Reasonable to exit below that bear bar, even below that little bear bar. It's also a double top, resistance at the prior lower highs in the bear trend. Very strong breakout often leads to a measured move, either from the open or low of the bar to the close or high of the bar, and that measured move is also right there. Another reason for bulls to take profits. Leg 1, pullback, leg 2, the measured move is in this general area as well. Another reason to take profits up there. Here we have a higher high major trend reversal, strong breakout, not good short. We have another top attempt here, so it's a wedge, 1, 2, 3. You can call this a final flag. You can call this a higher high major trend reversal. In any case, you're looking for 2 legs down, 1 pullback, 2 as a minimum, maybe 1 pullback, 2. If you take this as a lower high major trend reversal, your minimum objective is only 1 more leg down, because a lower high means you've already had 1 leg down. Higher high major trend reversal, bull trend, bear breakout, 10 to 20 bars sideways. Expect a reversal down, either below that doji bar, below that bear bar, below this bar, or you could wait and sell the lower high here or below these bars. Double top bear flag, you could sell below that bar, looking for another leg down, expecting a series of lower highs and lower lows, a bear trend. If you're selling a lower top, here we have a double top lower high major trend reversal. If you take that short, you expect at least 1 more leg down, because a reversal, you're expecting 2 legs down, 1 pullback, 2. If you're selling after the first leg down, if you're selling a lower high, you're selling after the first leg down, your minimum goal is 1 more leg down, although you can get many more legs down. Remember, the minimum goal of all bear reversals is a swing trade, and you're looking for at least 2 legs, 10 bars, 2 legs. TBTL, 10 bars, 2 legs. You want the reward to be at least twice your risk if you're looking for a swing trade. If you took the short below that bull bar, your initial risk is right above the high. This is 2 times your risk. That would be the minimum goal for taking partial profits. Most reversal patterns involve trading ranges, in addition to double tops and double bottoms. A major trend reversal, there's usually a double top, a trading range. A lot of times you'll see final flags and other failed breakouts. That final flag is a trading range. Wedges usually have trading ranges near the end. Double tops and double bottoms obviously are trading ranges. A triangle is a trading range. A head and shoulders pattern is always a trading range, and most head and shoulders patterns are also triangles. Rounded bottoms and tops, those obviously are trading ranges. And climaxes usually have at least a small trading range, a small final flag, or a small lower high or higher low after the climactic reversal. Today I talked about how major reversals have only about a 40% chance of leading to a swing trade. However, the 60% of the time when you don't have a swing trade, you're getting a small loss or a small win, and they tend to cancel each other out. And a lot of the 40% of the winners are very big, and they more than offset any of the small losses that you might have had. When you're looking for a major reversal, minimum goal, 10 bars, 2 legs. Also, look at the highest time frame chart that shows the pattern. If you're looking at a 1-minute chart, and the pattern is also present on a 5-minute chart. Don't look for 10 bars and 2 legs on the 1-minute chart. Look for the 10 bars and 2 legs on the 5-minute chart. Finally, I made the point that most reversals involve some kind of a double top or double bottom. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on reversals.